You're now listening to the Tax Smart REI podcast, the number one tax podcast for real estate investors. Are you ready to prepare for 2025 with strategies that will save you money and optimize your real estate portfolio? Whole CPA and Tax Smart Investors is bringing you the Year-End Tax Impact, a one-day virtual event where it will be equipping you with the tools you need to finish the year strong and dominate the year ahead. At this event, you'll hear from top industry experts on essential topics like how the post-election results will shape your investments and your taxes. You'll also discover wealth-building strategies designed for 2025 and beyond. Plus, you'll learn year-end power moves so you can optimize your taxes before the clock runs out. And for our VIP investors, you'll get exclusive access to a tax strategy panel and even a live Q&A where you get answers to your most pressing questions. If you're an individual investor or small partnership, this event is specifically tailored for you. And the best part, no travel required. You can join us from the comfort of your own home via Zoom. Don't miss out. Reserve your free ticket now by visiting www.taxsmartinvestors.com/year-end-tax-impact and arm yourself with the strategies and insights that could save you money, time, and a whole lot of headaches. With over 500 investors expected to attend, this is your chance to connect, learn, and prepare for a prosperous 2025. Again, just head over to www.taxsmartinvestors.com/year-end-tax-impact to grab your free tickets today. We'll see you there, but for now, we'll dive right into today's episode. Hey everyone, thanks for tuning into this week's episode of the Tax Smart REI podcast. This week, we're joined again with Troy Eckard of Eckard Enterprises, and we're going to be going through a case study on working interests in oil and gas. Over the years, we've gotten a lot of questions from Tax Smart insiders, the community at large, as well as clients on oil and gas. So I think it's going to round out this year's topics on oil and gas. So Troy, thanks again for joining us today. Would you mind kind of giving our listeners a little bit of information before we kind of dive right in? I know you've been on the show before, but for anybody who may not have heard the prior episodes, just a bit of information on your background and kind of how you got involved in the oil and gas space.
Yeah, I think it's real important to know that I started in the industry in 1985. So I was participating in drilling wells when I was 20 years old as an investor and a financially licensed broker representing wealthy clients. So I've been doing this going on 41 years, and the industry's evolved, the technology's evolved. A lot of the same tactics are used today investing, both from a tax planning perspective, but also from the way deals are structured. And I think it's a great asset class, but it's also a very precarious one if you don't know what you're doing and who to do it with and how to navigate it. So it's a great opportunity to talk to you and your clients about the advantages, the disadvantages, the things to look for that can hurt you. Those things are going to be really helpful to build some net worth and create some tax opportunities. So glad to be on the show, glad to be of help, and hopefully we'll be able to put together some simple information that helps your listeners find out more about this asset class.
Yeah, absolutely. So for everybody who's tuning in right now, Troy's going to be going through a case study on working interests. And then Ryan and I are going to have some questions for the end of the episode. If you are watching on YouTube, you will be able to see the presentation. If you're listening in here on the audio version only, we'll do our best to kind of facilitate that so that you understand what's going on without the visual representation. But if you do want to check out the YouTube version, check that out by visiting the Tax Smart REI YouTube channel. But having said that, Troy, I'll go ahead and turn that over to you.
All right, ready to rock and roll. So I'm going to do this for about 15, 20 minutes. And at any point in time you want to slow me down or ask questions, do so. More importantly is that I've been doing this for 40 years. So there's nothing that I'm going to have to stop and think about or pull my notes out. So let me just walk through this for your listeners and for those of your clientele and those that are part of your following of your podcast and your organization, what it looks like to be in a energy asset class that's defined as working interest. The reason why it is so important to understand is because it's like the difference between traditional real estate. One group of investors in oil and gas is like the landlord, that would be the mineral owner. And the second asset class is like the developer and the tenant, which is the working interest owner. They're running a business, they're paying the bills, they're getting the net profit, but they still got to pay their rent. And that is what the mineral owners get is the rent. They get a percentage of all the income and they don't have to spend any money to develop the wells. Today, we're talking about being the tenant. We're talking about drilling wells, participating in domestic exploration, what that looks like, what it looked like 10 years ago versus today, what the risk looks like. And then I'll go into a case study about how you can start telling deals that are structured from the very beginning where you've lost money the day you wrote your check. And it's pretty simple math. So let me get started. First off, there's only two reasons to invest in working interest. I mean, realistically, working interest is about either trying to get tax deductions, which is part of the process of the IRS passing in 1986 the Tax Reform Act. During that act, they said, look, we want domestic exploration. We're willing to reward high income earners, high net worth investors. Let's give them substantial tax write-offs So that way they're encouraged to drill wells here in the United States. We needed the production. We were very low on supply, way outpacing it based on demand, big tax write-offs. That's been around since 1986, the year after I started in the business. The second reason is to make money. Most people don't understand you actually can make a lot of money in drilling domestic oil and gas wells. And to be candid with you, that's all I'm interested in is making monies. I'd rather pay my taxes than lose the other 2/3 of my money. So for me, it is two things involved, but I'm more focused on the green envelopes and the making the cash and the profit than I am about saving the taxes, although it's a great benefit. Now, when you think about working interest, I want to give it to you in a simple legal term, which basically means this. We're going to create a contract with a mineral owner and say, we want to go drill a well on your property. We'll give you 20% of the revenue. You're going to get a royalty check every month for the oil and gas that's produced and sold. We, on the other hand, we agree to take ownership, and we are like a general contractor. We're going to put together the bids and the budget. We're going to go drill a well or wells on your property. We're going to pay all the costs, take all the risks, but we're going to get the lion's share of the revenue. We're going to get 75 to 80% of all the revenue from the success of the wells that we drill. And you, my friend, the mineral owner, you'll get your pro rata share if we're successful. So it is really an active participation. It's like building a 2-story building. We're going to get an architect, we're going to get a geologist, we're going to get a contractor, a drilling contractor to drill the well, have all the ancillary services that are involved, and we're going to go out and drill us a well and make some money by producing the oil and gas from that well. That's called working interest. So let's just tell you from the very get-go, this is the main driver for private investors when they decide to invest in working interest. Because of the 1986 Tax Reform Act, when you write a check participating in domestic exploration, you are allowed to start looking at the tax deductions that come with it. What kind of tax deductions are they? Well, when you drill a well, the cost of drilling, turning that drill bit to the right, the fluids used, the chemicals used, the way you drill the well, well, that's not a recoverable cost. In other words, it's not like a piece of pipe or equipment that sits around for the next 5 or 10 years. It's a one-time cost incurrence, so it can be expensed. So when you look at an investment today, if I put $100,000 in a U.S. domestic exploration project, working interest, I could end up saving $37,000 by the time I deduct the leasehold cost, the geology, the drilling, the completion, the equipment. I technically could get 100% deduction over the next 5 to 7 years. The way the IRS set it up, though, is they allow you to take an accelerated deduction. You could take 70, 80% of that investment as a write-off in year one, or you could amortize it over 5 to 7 years. Either way, the entire investment is eligible for tax deduction at some level, whether it be depreciation, whether it be a depreciation, or whether it be an IDC, an intangible write-off that year. I like to keep it simple. Just think to myself, for every $100,000 I invest, I've got a potential savings of $37,000, assuming I'm in the 37% tax bracket. The thing I want to get across to your audience, though, Thomas and Ryan, is the following, and that is, whether it's a great well or a dry hole, I get the same tax write-offs, right? The only difference is with a dry hole, I lose 100% of my money. We don't want to do that. We're trying to invest in working interest to make money, and we really want to just defer the taxes that we owe this year on the income that we made by investing in domestic exploration, and then allowing the wells, when they generate revenue in 2025 or 2026, we'll use that revenue yet next year, the year after, 2027 or on beyond. As we receive that income, we'll pay taxes if necessary when it's incurred, when that income is recognized. So really, I look at a tax deduction oil and gas as no more than really a tax deferral, because I plan on being successful. I don't want a dry hole. I want to make a great well, create a lot of income, and use the IRS's money today to increase my net worth and create a higher level of investment capital base by using those IRS dollars according to the IRS code that's available today. All right, when we think about due diligence, this is really important. We talk about case studies, right? There's 1,000 ways that people can promote or offer you participation in a working interest project. 98, if not 99 out of 100 of them are not legitimate. The promoters that are out there offering oil and gas, they literally rely on the fact that 95+% of most investors have not a clue how working interest works. So it's very easy to skin you. It's very easy to cheat you. It's very easy to over promote you. It's very easy to put you in drilling deals with that big flag waving, talking about a tax deduction. You have no clue what you're doing. So due diligence is not just words. It takes action. What kind of action are we looking for? All right. It means you have to have a discipline and a meaningful amount of questions that you're going to ask the sponsor that's trying to get you involved in working interest. And then you must demand and expect those answers. If you don't get answers to the questions, then you walk away. One of the things we believe is that working interest is a tremendous asset class, offers a lot of long-term cash flow, monthly revenue, severe or significant tax deductions along with tax-free income. But if you're not asking the right questions, you're not getting those answers, you basically are giving yourselves a very low, if not a zero probability of success. And meaningful questions mean what? Not like, well, how long you been in business and has anybody sued you? Because somebody who's unethical is not going to answer those questions. What you really want to ask is questions like, how long have you been involved in working interest in drilling wells? How many funds have you raised? What kind of financial returns have you had? Have you ever had any accidents or anything that's caused liability beyond the normal scope of investing to your investors? I mean, you've got to have some substance and meaning. So that's why I think due diligence is really made up of several key elements. Number one, the team. I need to know who's behind the decision making that's going to offer this investment, that tells me they're experts at working interest in drilling wells domestically here in the U.S. I need to know they've done it before, they can do it again, they have a on-site team of either geologists or engineers or access to consultants that do that for them. I got to know the deal. How's the deal structured? Is the deal structured in a way that's fair, that I have a high probability of success, or has the deal been so muddied that by the time I invest in it, even the best well that could be drilled doesn't make me a financial return that makes it worth my time and risk? Then you have the strategy, the economics, the risk to reward. These are always really key components when you're looking at the due diligence and looking at the elements that make up a proper due diligence. Now, the thing about it is, if most of you do not know or have never been involved in working interest before, then you may say, well, I don't really know what question to ask about a well. Well, it doesn't matter if it's ostrich farms or a mobile home park or a self-storage venture or a multifamily or working interest, it's always the same. I want to know who's behind this because I need to know your resume and your antecedents tell me you're capable, qualified, and trustworthy to manage the money. And then each category has common sense questions that anyone would be able to ask, but you must get the answers. And some of these people just simply will not answer your questions because they know once you ask and they can't answer, you're not going to invest. Well, that's the key. All right. So if we look at a dead on arrival deal example, this is an example I just looked at last week. So we talk about case study. There was an investor of mine said, hey, look, I'm looking at an investment. This guy's drilling 2 wells in the northern part of Oklahoma. He's raising $1,625,000. He's asking $125,000 per investor, 13 different investors making up the total capital raise of $1,625,000. He's given us 3% interest. So all 13 units are going to divide up that 3%. So if you divide it up, it tells me my share is 0.2285. He's going to give us 75% of the revenue because the mineral owners are going to keep the other 25%. And maybe there's a few sticky fingers involved in that as well. So, but nevertheless, 75% of the revenue is going to go to those of us who pay 100% of the cost. So I own 2.25%, and I'm only getting 0.1713 of the revenue. This will make sense in just a second. So I just want you to understand that it's all mathematics. It's numbers, right? So this deal is dead on arrival because why? Because if I go to the next slide and I say, well, if each unit is $125,000, that means I'm essentially paying $62,500 per well, 125 divided by 2. And then I divide that by my working interest. Well, it tells me that this individual is charging $27 million per well by the time I gross up the actual cost he's charging me. And it shows you those numbers here on the slide. So what I've got to do is I've got to make $60 million back from the oil and gas sold to make back my investment. These wells only cost $7 million. So the minute I write a check for $125,000, this promoter, this individual, without you knowing as an unsophisticated, unaware investor, what you're really doing is you're giving $125,000 and maybe $25,000 is going to the well. The other $100,000 is going in his pocket. So for each $1,650,000 investment he's offering to investors, he's making about 1.1 to 1.2 million in his pocket. He could care less if the well ever pays out. In fact, he hopes it's not economical. He hopes it's dry because he doesn't want to have to explain why you have this really nice producing well and you've never even made back a third of your money. He's charged you 4 times the price. This happens day in and day out. So now let's talk about what I think is also real important, which is whether you've been involved in oil and gas working interest in the past or today, what you really have is an advantage today that we've never had before in my 41 plus year career. We now have the opportunity to drill wells and not be worried whether the well is dry hole or commercially productive well. So the old days, the U.S. was like trying to hit a target that was a mile or 2 miles in the ground. So it'd be like the guy in the bottom right-hand screen. He's shooting bow and arrow. He's trying to hit the bullseye, but it's going all over the place. The size of a well bore is the size of a paper plate you might eat on at a picnic. It's 7.5 inches in diameter. So you get a geologist, a geophysicist, a drilling crew, rig hands out there. You say, look, somewhere down 5,000 to 10 to 15,000 feet below the ground, I need you to take this 7.5 inch string of pipe and try to hit that little green hole in the ground 1 to 3 miles below. And if you're off by 100 or 200 feet, one way or the other, you could literally miss what used to be a buried river channel, or maybe it's a buried lake or a pond that was compressed over time and full of oil and gas in a geological formation. It was super risky. So getting the tax write-offs had to be in place, or you and I as private investors would go, there's not enough reward for me to justify the risk. But in fact, by getting big tax write-offs and the potential of these wells hitting, it was enough of a lure to get investors to invest the last 35 years. Well, that's all changed. What's changed now is that we discovered these buried Grand Canyons that are all over the country, mainly in the central part along the Rocky Mountains. And of course, we have the Appalachian area over near Pennsylvania, New York, which is the Marcellus play. And now what we're doing is saying, can we actually hit the Grand Canyon by standing on the edge and throwing a rock? Now we have these basins that are about 4,000 and 9,000 feet below the surface. They were big erosional events. They were filled up with dead plants and animals. Then over time, the oceans came in and filled it all up, compressed it with high pressure of earth on top of it. It cooked over time because of the magma in the ground. Not getting too technical on you. Basically, we had this big boiling pot of rice in the ground, but man, it was as hard as wet concrete. We're like, well, we know it's full of oil and gas, has tons of organic material. We don't know how to get it out. Well, how do we get it out? Well, we're going to drill horizontally. We're going to go sideways. We're going to put that drill bit down there and use modern software and hardware and technology to guide these drill bits into little 20-foot windows, 2 to 4 to 6 miles in the ground, and do it with such precision. Not only do we know where the oil and gas is, but we've exposed our well to as much of the oil and gas reserves in the ground as possible. And we learned that if you take wet concrete and jackhammer it, it creates artificial fractures that make that wet concrete flow water. Well, if we go down and drill horizontal wells in this really, really hard rock, and we go along 1 or 2 or 3 miles horizontally, if we come in and inject water and sand really hard, it'll break it up and make that oil and gas flow, which has never been able to flow before. Bingo, we solved the problem. Horizontal wells and frac stimulations. So one of the things about working interest is you really have 3 components. Number 1, I want to make money. So I got to be drilling with the right company in the right area. Number 2, I have to understand the premise of investing in working interest. I want to be just like a major oil company. I want to be like Exxon or Chevron or any of the other majors. And I want to deploy capital with the intent on recovering that capital through monthly revenue upon the sale of oil and gas from the wells that I drill. And what I want from that revenue is to get a return on my capital in 36 to 48 months. Most of the majors target 24 to 36 months. They want their money to rotate every 2 to 3 years. Well, if you took $1 billion and rotated it over the next 2 or 3 years, you could keep doing that for 5, 6, 8 years. Also, now you have a multi-billion-dollar company who continually compounds the reserves in the ground that they've proven, and they continue to add revenue by the wells that are online that have already produced enough oil and gas to get their money back. So what you see on the screen is a typical decline curve from a horizontal well. When you frack them, it's like opening up a hot 3-liter Coke. You shake it, it's got a big orifice. You're going to get a lot of that Coke out of it at the very beginning. That's when we get the production that allows us to get our money back for participating in drilling. And then after that, it settles down. And now we have a 3-liter Coke that can last 25 to 50 years. What we used to have when we drilled the old vertical wells, like I showed you before, that paper plate, we'd go drill these nice little bitty shallow wells vertically. We put a hole in the ground, and they would deplete and be dry in 5 to 8 years. So we got a lot of fizz, a lot of oil and gas production. We had nothing that was sustainable. So we constantly were running on a treadmill. Horizontal drilling has stopped that. Now, from an investor standpoint, I can invest in working interest, get a very substantial tax write-off, and have about a 95+% probability I'm going to make a commercial well. It's going to pay my money back and last 25 to 50 years. It completely has changed the risk profile of working interest as long as you're not investing with a crook or somebody that's incompetent. So here's a timeline how things work. So let's say today, October the 22nd, we decide to make an investment in working interest. I'm going to put $100,000 in. I'm going to notify my CFO or my accountant and say, hey, look, I just made an investment in working interest. I just wrote a check for $100,000. Your CPA, your tax planner is going to go, great. So I'm going to consider that for this tax year, you probably have a $100,000 working interest investment. Normally it's between a 70 to 85% deduction the first year because I'm probably going to have to depreciate my equipment and maybe have a depletion cost for my leasehold. So let's just say 80% of my investment will be deductible this year, the year I make the investment. But I'm going to be able to recognize it immediately because my CPA is going to factor that into my tax planning. I'm going to get a tax report from the oil company or the sponsor that took my investment. He's going to show me, hey, you made any money? Here's a 1099. If you didn't make any money because you just invested and the wells will be drilled in the first quarter, well, I'm going to give you a tax summary of the cost of the wells that tell you what is deductible this year, what's intangible that can be written off, what's tangible that has to be depreciated. I'm going to get a tax summary, right? Well, those wells should be drilled on or before March the 15th the following year to apply for tax write-off purposes for this year. So whatever I invest, as long as they start activity by March 15th of next year, I get to use that deduction for 2024. Well, once they drill the well and frack the well, most likely it'll be around June. These are 5,000 to 10,000 foot lateral wells. These wells cost anywhere from $8.5 to $10 million a piece. They'll drill them back to back. It's a big operation, but they've been doing this for years and it's very systematic. But at the end of the day, all I care about is a check written today, gives me an immediate tax write-off, and I would expect to see my first revenue in 9 to 12 months. It could be anywhere from next August to probably October. But once that revenue starts, it's every single month, and these wells are projected to last, 20 to 50 years. That is the good part about it, is I am looking at an asset that gives me immediate relief from taxes, very quick turnaround to get to cash flow. I get tax-free income with 15% of my income not having any taxes paid on it. And I have an asset that's going to go out there and produce for me for the next 20 to 50 years. It's a great asset class, okay? Then we talk about Eckard. And I'm using Eckard only as a premise of what you got to ask for from other potential working interest opportunities. Why? Well, we believe here at our company that we set the bar for transparency, proof of concept, prior performance, best in class. So I want to give you an example of what we do so maybe you can start looking at how others might present you oil and gas working interest opportunities. And you start asking questions like, well, how have you done? How many wells have you drilled? What kind of production do you have? What's your rate of return? How many bad investments do you have? These are all critical in the due diligence process. So for us, here's what it looks like. So the average days from the time we drill a well until we actually start selling oil and gas is averaged 168 days. That's all of our wells. We're like almost 85, 90 wells in the last 4 years. Average days from the time they drill until we give you a check is 375. Why is that? It takes about 90 days for the production, the collection, the sale of the oil and gas. It goes back to the operator, who's the general contractor, to run it through the revenue. They got to verify ownership. By the time that's done, it's about 4-month, 5-month process for all the processes in place, land, title, accounting to happen in order for you to get your check. So we take a look now. This is as of 2024. Our average year-to-date return is 17.58%. because we've offered a lot of new projects this year, so it waters down our year-to-date performance. But when you look at average total return of investment, we're at over 80% return with an average annualized yield of 32.72%. Now, this is something that I would expect if I'm investing in successful wells, that I'm going to be looking at rotating my money, getting the majority, if not all of my money back in 36 to 48 months, and allowing me to redeploy that capital year after year after year. Not only the reinvestment of my income, but I'm also going to take brand new income from other ordinary income generating sources like my occupation, use that to keep compounding my value and creating further assets of value and further income that's being added for every well that's drilled. When you take a look at it, this won't mean much to most of you, but we've produced about 9.4 million barrels of oil out of the wells we've drilled and 65 billion cubic feet of gas. This is a tremendous amount of oil and gas that's been discovered from our wells. And by the way, we've had one well out of the entire group of wells that I believe was non-commercial. We drilled it with Exxon. It was a test well. It was on the outer fringes. We knew what we were doing. The well didn't work out, made a little bit of money. But after that, virtually every other project we have is on chart to make its money back and make a nice profit for every single well that we drill. That's what I mean. Dry holes really aren't in the game anymore. So number one, I don't drill any vertical wells. I suggest you not. I don't do any reworks or re-entry of old fields with the promise that somebody left oil and gas behind. That's nonsense. In today's modern oil and gas world, work and interest should be in shale plays, in horizontal drilling with the right terms, and know how to do the math to make sure you're not paying 4 and 5 times the price for the well. All right, in a case of just showing you what I would call tax deferment, watch how this works. Let's say this year in the green up here at the top, I had $250,000 I invested. Well, like I told you, it's going to take about 12 months to get that first check. So maybe next year, by the time we get to the last quarter of 2025, right here where my arrow is, I'm going to make $179,000 in revenue next year because these big wells come on very hard and fast in the first 6 to 12 months. So I'm going to make a big chunk of money back in the first 12 months. Well, if I go to 2025, I invest the same $250,000 you see here in blue, and I add back the $179,000 from the income I made from this year's investment, I got a total investment of $429,000. You carry that out over 4 years. Now what you're doing is you're making a $250,000 investment. You've got about $895,000 in 1099 income being generated from the wells from the previous 4 years. Now I'm really invested about $1.145 million in year number 4, but I have now $3 million invested in working interest in oil and gas wells that'll last 20 to 50 years. It is what I call and refer to as tax deferment investing. Because why? I've been doing this since 1985. If I keep drilling wells and I keep deferring the taxes, I'm building wealth and cash flow and producing assets with lots of reserves in the ground. I'm using the IRS's money. I'm allowing myself to reinvest. And if next year I want to pull out $300,000 or $400,000, go buy myself a small lake cabin or a house or do some other investing, I can do so. But I can do so with my tax planner to figure out what my tax bracket would be. Is it a possibility of doing a 1031 exchange? Is it a possibility of doing any kind of tax deferment? All these things can be considered. If I don't have any use for the income, I'm going to reinvest and just keep creating more and more wealth for myself. So just as a recap, you have 3 years in which you probably should not sell your working interest because the IRS is going to ask for a recapture of any tax write-off. So really, you want to be in this for 3 years before you even think about selling it if you do want to sell it. 75 to 80% tax deduction first year, 15 to 25% depreciation, which is your leasehold cost, and of course your equipment. Income starts in 9 to 12 months, and 15% of your income you don't pay taxes on because the IRS says you're depleting the reservoir, so therefore we're only going to charge you tax on 85% of your income. Look, this is the way my life has been since 1985. It's about drilling domestic wells, buying oil and gas mineral rights, allowing the IRS tax code to be an incentive for me to invest, get immediate relief from the taxes that I owe this tax year, use those tax dollars, use those income generating monthly checks I get from oil and gas wells, reinvest that, and just continue to compound and build my net worth, build my production, build my proven reserves, and do it all through cash flow and tax deductions that make this a very solid investment. This is the scan code you can use to scan to get information from us. You can sign up at our website. But Thomas and Ryan, I know that this is a little bit fast, but I realize that a lot of your listeners can hear 300 words a minute. It's my job to not waste their time, so I talk about 300 words per minute.
With the end of 2024 right around the corner, now's the perfect time to start planning what moves you're going to make to optimize your tax situation before the year ends and get a head start on 2025. Whether you're looking to use the real estate professional status, the short-term rental loophole, cost segregation studies, 1031 exchanges, or anything in between, our team is here to help you through proactive tax strategy and planning, painless tax filing, and streamlined bookkeeping services. After helping thousands of investors save millions of dollars in taxes, we want to help you. So whether you're looking to finish the year strong or get a head start on 2025, what are you waiting for? Head on over to www.therealestatecpa.com/podcast to request a free 30-minute discovery call today. We're looking forward to learning more about your situation and how we can help. Again, that's www.therealestatecpa.com/podcast to request a free 30-minute discovery call. We look forward to hearing from you, but for now, right back into today's episode.
I've got a question I'll kick us off with. We talked about, 1986 tax code. They put in this huge incentive for the working interests in oil and gas, which we just went through. So the incentive, right, from the government is, hey, you're going to take on a huge amount of risk if you put a bunch of your capital into something like this. But through the decades, right, almost 4 decades now into this 1986 tax code, things have changed significantly with our technology. And like you said, like the risk is way less.
Yes.
It seems like the incentive is still there, but the risk in some aspects, as far as like the dry well risk, has significantly decreased. Do you think that's the intention? Do you ever see them like maybe rethinking this and saying, hey, you know what, the risk is way less, so the reward should be a lot less?
Yeah, I think that's been the premise for the last 8 years, even after Obama got out of office. It was, look, we gave you a tax write-off because you had this big risk of losing your money, so we're going to reward you. And the premise now is, well, you're not taking as much risk, but we're now giving high-income earners this big tax write-off when really they're not risking that much. But the counterintuitive defense of that is, well, if you take away the tax write-off, then I just won't drill. I'll go do something else with my money. And what has happened is about 20% of the oil and gas industry in the U.S. is made up of independent investors like you and I. So that's a huge part of the oil and gas sector that would stop or at least come to a very small continuation of activity without that tax incentive. If I didn't get the tax write-offs, I probably would still drill, but not near to the degree that I do it now. So what I look at is, yes, risks are lower, but let's face it, there's still a lot of risk. What's the risk? 2020, when COVID shut in, I had wells making me a lot of money. For 6 months, those wells didn't produce a drop, or they were very minimal compared to what the cost. I had to write checks every single month to the operational cost. It'd be like having an apartment complex that went from fully occupied to be completely empty. So you do take commodity risk, you take regulation risk, you take all kinds of different alternative energy risk. So I think the risk reward is pretty fair considering the tax write-off you get. And quite frankly, if I had 1,000 millionaires in the room, high net worth, high income earners, maybe 10 or 20 are really suitable to be in working interest. Why? It's not whether you have money or not. It's whether you understand the tool that is available to you through investing in working interest. And most people just can't stomach I don't really understand it. I don't get it. So I'll just pay my taxes or I'll do a conservation easement. But at the end of the day, if you truly look at working interest, it's a phenomenal tool, but you got to have the right company.
That's good. The next thing I was wondering about was, as an investor who's maybe going to, in your example, you put like $250,000 investment or $100,000 investment, is that person, taxpayer, investor, investing into like what type of entity usually, like LLC, a corporation? Can you talk about that?
Yeah, we do it under a purchase sale agreement because the IRS requires you to be at risk. So what you'll have to do is take the risk that you're going to be a joint and several liable partner, which sounds scary. But what happens is that the operator carries massive insurance, both with the drilling operation, all the vendors, et cetera. And when generally speaking, the IRS says you need to be at risk at least for the primary year in which you make the investment. What a lot of clients will do is invest in their own name or a single member LLC. They'll go through and get the tax deductions for the first year. Then going into the second year where they don't need the tax write-off, they'll roll that into a family limited partnership or an LLC to give you that kind of isolation of that risk, but they'll do it in a way that allows them to terminate that ongoing liability from the standpoint of isolating a protective entity. If you're in any way involved in a partnership or an LLC where you really own the LLC or you own the partnership, you don't own the asset, you won't get the tax deduction. So the way we do it, Ryan, is we'll let clients invest. We'll give them a purchase sale agreement. We hold the title in our name. We handle all the insurance. We cover all the coverage. The client is the owner. The IRS sees them as an owner. But you've got major backstops between what we do and that individual client. And I can just tell everyone watching, this is God's honest truth. For 40 years, I've done 1,000, 2,000 wells that we've drilled. I can't remember the count anymore. We've had wells where guys have been killed. We've had rigs that have had accidents. Everything happened. Not a single lawsuit or a single notification of a lawsuit in 40 years to any client or my own company because there's so much insurance involved. So I don't want anybody thinking that this is an event that can happen. It can always happen. There's always the unforeseen. But in 40 years, not a single lawsuit, single notice, or a single client ever pursued on any kind of act or any kind of activity on a rig or well, ever.
Hey Tax Smart investors, Thomas Castelli here, and I want to let you know that I recently started my own YouTube channel where I'll be releasing weekly videos on tax and wealth tips for real estate investors and business owners, and of course I'll be covering many personal tax strategies as well. But that's not all. I'm also going to be sharing the tips and lessons I learned by investing as a limited partner in real estate syndicates and funds, which you'll only find available on YouTube, and I'll be diving even deeper in Tax Smart insiders. And lastly, in the not so distant future, I plan to cover estate planning strategies for real estate investors, and you'll only find that on YouTube. Subscribe today so you don't miss a beat by visiting youtube.com/@ThomasCastelli or by searching @ThomasCastelli on YouTube. Again, subscribe today at youtube.com/@ThomasCastelli. I'll see you over there, but for now, right back to today's episode. I know kind of in the one slide, you showed us the spreadsheet with a $250,000 investment over a 5-year period with, assuming they reinvested and on top of reinvesting their income from the wells. So 2 questions on that. The first one would be, so say someone committed to that 5-year plan, right? I'm going to invest a certain amount of capital every year on top of the income. After year 5, they've accumulated enough wells that those wells kind of pay out in perpetuity. Is that how I'm understanding it?
Yeah, well, you got to think about it this way. Every day a well produces, there's less in the ground, right? Hypothetically. But I can give you a practical experience, which is wells that I drilled 15 years ago are making me more money today than they did 15 years ago, because 15 years ago I was selling oil at $27 a barrel, and it came in at 400 barrels a day. Well, today I'm making 80 barrels, but I'm getting $75 a barrel. So one thing that's clear is not only the reserves in the ground, they're calculated by today's economics. Like I can get this much oil out of the ground at today's operating costs and today's commodity prices, I can get 400,000 barrels per well. But if oil prices go to $85 a barrel, I can get 600,000 barrels out. You're like, well, how did 200,000 barrels show up? Well, I can afford to pull the tubing out, put brand new tubing because the other tubing had a hole in it. I can put a pump jack on it for 400,000, whereas $70 oil doesn't justify that. I can clean the sand out of it like cleaning out a septic tank, whereas $70 oil doesn't justify that. So what happens is we look at the reservoir itself and we say that reservoir, let's just say at 100% capacity at today's economics and today's technology, we're getting out 8 to 10%. That means 90 to 92% of the reserves that are in place, we're not getting out because we don't have the technology or commodity prices are too low. So when you look at that repetitive investment, what I'm counting on is a couple of things. What Troy wants for Troy is I want to invest today, take those tax benefits today. That gives me a bigger purchasing power. I can buy more because I'm using IRS dollars. I want to invest in wells that have the probability, better than a 90% probability, I'll get all my money cash on cash, no tax considerations, cash on cash. I want it back in 36 to 48 months maximum. I prefer 36 months. And then what I want to do is look at ongoing drilling and saying, if I've got a certain part of my normal income I'm investing in wells every year, I don't really need that money. So do I go buy a piece of real estate? Do I go buy a self-storage? Well, what I want to do is I want to use that to buy another part of or more working interest because I don't want to pay the taxes on it. I do that over 5 years. I got $3 million invested. I'm making $800,000 a year. Well, why would I not want to continue? But now let's get into practical sense. So I'm 60 years old. Let's say I'm 70. I'm going to start asking myself and scratching my head, like, do I really want to be drilling more wells? Well, maybe I don't want to drill as much. I'm in a lower tax bracket, blah, blah, blah. Maybe I'll start taking and reinvesting 25%. The other 75%, I'll pay the taxes on it, and I'll put that in another investment that's less risky because of my age or my income is going down. So it's really about using a tax planner, somebody really efficient in what they do. It's looking at asset alternatives at the time that income is derived in whatever year it's derived in, and managing those assets so you're maximizing tax value, but you're also not afraid to take some chips off the table if it's an appropriate thing to do. So let's say I want to, like Troy, I want to go buy a lake house. So I want $600,000 to buy a lake house. I'll just look at my taxes this year and I'll go, hey, tax planner, CFO, I'm pulling out $600,000. I'll pay the taxes on that. I got some additional deductions and I reinvest what I don't. And then I just keep compounding. I've been doing it since I was 20 years old in 1985, which is why I'm always got a smile on my face. I got thousands of wells making me money every day and got tons of reserves in the ground. I mean, they're the best friends you can have. They don't complain. They make you money every day.
Yeah. I mean, this oil and gas definitely does seem like a very interesting investment. And I know, kind of just going back to the investment thesis of doing it over multiple years, I know you mentioned 250. Is that the minimum viable amount to make this like a worthwhile investment? Or could someone commit $50,000 or $100,000 a year and make this worth something?
So here's how we do it. So we've committed to drilling this year. We're doing about 50 million in drilling. Next year, we'll do about 250 million in drilling. The reason I used the $250,000 increment is we just placed a 5-well program. I said, look, let's just say you're going to put 50,000 per well, so you need 250,000. It kind of moves the needle. So we're dealing with people that generally make 600,000 to several $1,000,000 a year. So they have a lot of income beyond their financial needs, their house, their mortgage, their kids, their cars, and school. So this is a lot of extra income that if they don't take and utilize with tax deductions, they're going to give away most of that money to the IRS, right? So this is about using the 250,000 just because we had a 5-well program. We're coming out in November with our 2025 drilling program. That'll be roughly a $100 million project. It'll be 10 wells. And in that program, somebody might say, look, I only want to put 250,000, so I'm going to only have 25,000 per well. It's not really the dollar amount, but I will be candid with your audience. You can't build a brick house if you only can afford one brick. So some people go, hey, I want to put 25,000 in drilling. You going to do any more? Nope, I just got 25,000. Well, two things alarm in my head. You really don't have that high income because you need a hell of a lot more than 25,000 if you really have decent income. You're probably not qualified to drill. Number two, if you're going to tiptoe through the tulips, well, you're really not going to gain any momentum in this asset class by putting 25,000 in, waiting for 24 or 36 months to see if it works and go, oh, it worked. Let me go drill again. Because what happens is it is going to work. You're going to make money. You're going to save taxes, but you got to treat it not as gambling. You got to treat it as an asset class. And so the right mindset is I'm going to go to my tax planner and say, I'm going to make 750,000 this year. These are the only deductions I have. Tax planner is going to look at me and go, well, you're going to owe taxes on 500,000, buddy. Wow, what bracket am I in? Well, looks like you're in the 32.7% tax rate for that additional 500,000. What if I put 100,000 in drilling? Well, you just save this much in taxes. Well, just make a choice. Go to your bank and pull out the taxes you owe, or go to the bank, take the 100,000 out and put it in 3 or 4 wells, and know you immediately save some money. So it's really not how much you invest, it's really the strategy and the commitment to be in or out. See, I'm a simple guy. I'm either all in or I'm all out. I know I'm going to always have high income, so I'm always drilling because it makes me a lot of money and I don't like paying taxes. I'll pay my taxes that are owed, but I don't have to if I don't want to, right? Or I don't want to if I have to. In this case, your clients, your listeners are going to have to decide, well, is $25,000 really worth me getting in this asset class if that's all I can afford? The answer is no. Well, what if I make 400,000 this year? Well, you probably have a tax rate of probably 31% or less because you got itemized deductions and blah, blah, blah. So maybe you put 50,000 in and you got, 12,500 per well. I don't know. The key is not the dollar amount per se. I use the 250 as an example because we just funded $37.5 million worth of drilling. I think our average client put in probably $400,000 each because they don't know of anywhere else to go with the money that's going to save them from paying those heavy, heavy taxes that they pay. So it is probably more for your high income earners, not your $250,000 income earners.
Got it. So the key is you're spreading out the money over multiple wells over multiple years. And that's kind of how you have success in oil and gas. It's not like a one and done. Oh, I invested, this year I have, a high tax bill. So I'm going to try to use this as a one-time tool. It's a longer term strategy. It's not just, like I said, not just a one and done.
Thomas, I'll be candid with you. I've been doing this so long, for 40 years. I love drilling because it makes me a hell of a lot of money. So I just told my CFO this morning, I said, every day he brings me another yellow envelope or the pocket blower says, here's 5 more wells, here's 3 more wells. And I love doing it because these horizontal wells are ridiculously good. I mean, they're coming in 800 to 1,000, 1,500 barrels a day. So in some cases, like my wells in North Dakota, I'm getting paid out in 9 months. Where else can you go put $1 million and see your money back in 9 distributions? There's nowhere I know of, right? So what happens is that when I think about the way I approach drilling, I like the tax run-ups. That's fine. But I know I'm going to make great wells. So I'm going to know the taxes sooner or later anyway. So it's kind of like, today or tomorrow, come see, come so, I don't care. What I like is that when you look at the industry and you look at Exxon, Chevron, Diamondback, the big boys, the reason they went and bought each other out and why there's been this massive consolidation is there's no risk. So when Exxon bought out Pioneer for $60 billion, Exxon goes, you probably have 40,000 additional locations to drill. It's probably worth $1 trillion we picked up for $60 billion. They think they stole the deal. Well, as a small peon investor, if I go out and put $100,000 in a well that Exxon spent $9.9 million drilling, I'm getting the advantage of Exxon's best engineers, geologists, finance guys, production here. I'm getting to be a small fly participating with the smartest oil companies on the planet, and I'm getting the same economic benefits they get. So never in the history of my career in 40 years have I ever been able to put myself or any of my investors side by side with the most successful, knowledgeable oil companies on the planet Earth and drill side by side with them. That is astounding, which is why we're doing so well.
The purchase sale agreement that you're doing, maybe too granular for some folks, but just people, as I'm thinking about it, I'm sure other listeners are wondering. So for those people who haven't done this, you're giving them 1099. Yep. And basically the 1099 is just showing revenue. Right. Is that right?
Yep.
And then basically they're also receiving from you or whoever it is a tax summary, which essentially kind of shows like these are the additional deductions that are going to offset that revenue. And I'm assuming maybe you don't know because you're not a tax person, but probably just goes on a Schedule C. But the tax summary kind of shows their deductions associated with their interest in the well. Is that correct?
Yeah, I'm not a tax expert, but I'm a great parrot. So what I'll tell you, my CFO says is, you normally would get on a direct participation, meaning I'm not in a partnership or LLC. I actually own interest in the well. I own the well. You're normally going to get a Schedule C, or you'll get what we call a tax summary. Now, this is real important for your listeners. You want to have a tax summary tied to a budget. In the oil and gas industry, it's called an AFE, which stands for Authority for Expenditure. So if I were doing a general contract, like building a building, that general contractor is going to give me a list of everything that's going to cost to build that building so I can monitor cost overruns and make sure he doesn't gouge me. Oil and gas does the same thing. We'll build an AFE with our production engineer and our drilling superintendent. Says, here's the well cost, the gates, the locks, the pad sites, the tanks, the drilling, the chemicals. With this full budget, it's $9.75 million, right? When we do the tax summary, we will take the actual budget compared to the actual cost and we'll say, all right, Mr. Partner, Mr. Participant under the purchase sale agreement, this well is $9,750,000. The intangibles, the things that are tax deductible immediately, is this percentage. The tangibles that are going to be depreciated is this percentage. Your overall deduction is X, because we want to tie it back to an actual budget. And the reason I said this is important for your listeners, what a lot of these guys do, like the example I gave in the PowerPoint where the guy was charging $27 million per well, he offered it under a fixed investment cost, meaning you don't take any risk of cost overruns. It's a turnkey bid price. That way you can hide the 400% markup. But if you ever have an IRS agent come back and audit that, the IRS agent is going to say, well, show me the underlying cost. It has to be reasonable. IRS is not going to look at 400% markup as reasonable. They're going to look at maybe a 25% markup as reasonable. So that participating investor has the potential of having those tax deductions unwound, disallowed with taxes and penalties and interest. So what's really critical, the way we do it in a purchase sale agreement is you own it. We're going to show you the actual AFE. Every month you'll get a billing statement from us that says joint interest billing, $250,000 invested. Well, number one, it's spending money. Number two, spending money. You'll get line item expenses all the way through until the wells are drilled. If there's any money left over, we send you back a credit. But it tells you, your CPA, your tax planner, and the IRS is all tied to actual numbers and is real. That's why it's so critical you do direct participation with a purchase sale agreement and not in a partnership and not in a turnkey. You will lose your tail, have a lot of risk with the IRS, and you know darn good and well you just paid 2 to 3 times the cost and just blew a lot of money that's not going to be a return on investment.
So for maybe our listeners who are also obviously real estate investors, for those of you, it sounds like to me, this is like in the real estate world where we'd call like a tenant in common or a TIC, where you own a direct interest. It could be fractional, but you own a direct interest, say 10% of a building, like roof to ground, right? But all 10 investors own 10% of this building. It sounds like Correct. It's kind of like that. You just own your portion. It's no partnership. It's direct ownership. So you own the piece of real estate. Okay. Excellent.
Yeah,
that's very helpful.
Exact same thing. And that's also important because let's say in 2 or 3 years, Ryan, you want to sell yours. Well, it doesn't mean we have to sell, right? You can sell yours. And then we actually go out to the market with your interest and say, hey, out of our 2,000 high net worth clients, who wants to buy Ryan's interest? We can put that through our engineering model. We just did that to one of our clients who works for a big oil company in Houston, said, hey, I got bad health. I want to sell my working interest. We summarized in less than 2 days and bought her out. So this is because it's that individual ownership. We can all do what we think is best for us. And some people will sell in 3 years and do a 1031 out of working interest and go buy a bunch of minerals with it. Some people will keep it forever. Some people will buy other people's positions who are getting out because they want to accumulate more. So it's really kind of a unique way to do it. The reason why many of these groups will offer you what they call a GPLP, they do a general partnership, so you're at risk, but they hide all the numbers under a 2-inch thick offering document, meaning they promoted you to death, and they sell you on the idea, but by the fact you're in this GPLP conversion, you take the risk to get the write-offs, then we automatically convert you to an LP, so therefore you don't have to worry about it. You know what the problem is? I don't own the well. When you convert me to an LP, I own a limited partnership. I don't own the well. I want to own the asset because under that LP is a big fat managing agreement that tells me I'm going to strip that thing down, make all the fees, and you're not going to get diddly. So as I say in my world, the thicker the document, the more it protects the promoter. The thicker the document, the more the promoter's protecting himself. He paid the lawyer, right? I don't like thick documents.
All right. So want to thank Troy again for joining us again here on the Tax Smart REI podcast and breaking down oil and gas working interests, which are where most of the tax benefits of oil and gas investments are found. All right. Just a few key takeaways I have for myself. Here is the deal. All right. So what I realized about oil and gas working interests, it is like many investments, a long-term play. You're not in it just for any 1 year. As Troy kind of showed us, to really kind of ramp up your benefits, you need to be investing a substantial amount of money over at least a handful of years in order to accumulate enough wells to make this a financially viable investment for you. It's not just about the tax benefits. You want to invest with a company that knows what they're doing, all right? And that means you want to do your due diligence. And look, one thing I've learned, so I've been a limited partner in many deals, and I know this isn't quite a limited partnership type investment. We went through how it's a TIC. but you're still giving control to somebody else. Always do your due diligence on every single investment. Do not let group think or what other people are doing dictate your investment decisions. You want to make sure that you're asking the right questions, which is what Troy recommends. You want to make sure you're understanding what you're getting into, and you want to make sure you're committed to that. On top of that, if you're going to be making these types of investments, as Troy said, you want to be doing this with disposable income that you don't need. All right. So don't get too excited. Don't let the tax tail wag the dog. And again, always do your due diligence. But the bottom line is kind of what I learned from this is that this can be a very lucrative asset class. If you're in it for the long term, you have the right investment strategy, you have the right money, and you do your due diligence, it could be potentially lucrative. But that's kind of my takeaway from it. Ryan, I don't know if you have anything you want to share.
Yeah. I think you nailed it on the head where we talk about, not only this episode, but several others, not letting the tail wag the dog. It's really important here. We were talking about, primarily the investment itself. This is a tax podcast, so we obviously want to hear from Troy specifically with working interests, how that is unique in the tax code as far as how that is an investment that you could make, right? We say, for example, $100,000. Troy was kind of saying probably expect 80% of that in the first year back in the form of a loss. Well, if you follow the rules correctly and we're owning it essentially directly in your name or not through a limited liability company, then you can take that as a non-passive loss, right? Just like we talk about with short-term rental strategy, real estate professional status, except you don't have to materially participate. Right. It's really weird and it's really unique. But again, I appreciated Troy kind of helping us think through the rationale, especially as someone who's been in this right around from the time that this really gets started, when the Tax Reform Act in 1986, and how like the incentive was there from the government because the risk was so significant. They wanted to try to align risk and reward to say, hey, we know that you could have some dry wells here. Go and make this investment. We'll give you a huge amount of tax savings. Things have changed in 40 years, like we talked about, where the risk in a lot of ways has become less in the form of not as many dry wells. There is still risk. You just got to make that clear. Like if you go and read one of these operating agreements or whatever, these purchase sale agreements, there is going to be risk, period. You are going to want to review that with your attorney, whether you're putting in $100,000 or $1 million. Like you need to go review that. Make sure you are comfortable. Even Troy mentioned, hey, go talk to, I think he said 1,000 or 100 millionaires. 10 of them are going to be comfortable doing this. So we talk about it with our clients every once in a while. Okay. But it's not something that's like, hey, everyone should go and do this. We're putting this on our podcast because it's tangential to real estate and obviously tax savings, but we don't want everyone to go out there and just put money in there willy-nilly. That would be insane. But there's so many things that, as we talked about towards the end with Troy, that could potentially change as we come up to an election here, which is crazy, just in a couple of weeks. Things are always subject to change with the tax savings. So again, yet another reason where you don't want to say, hey, I'm going to do this every year for the next 10 years. That is all subject to change, just like anything else in the tax code. So make sure that you're comfortable with the asset class first and foremost. And like you said, Tom, that this is a long-term investment that you're interested in holding on to.
Right, 100%. And I think we talked enough about oil and gas for today. Definitely a viable investment. Again, please, anybody out there, do your own due diligence. Make sure you're comfortable with it. Make sure your advisors are comfortable with it. And realize that with most investments, whether it's real estate, oil and gas, or really anything else, it's not just about today or saving this tax year. It's about the long term. Okay, so keep that in mind as you filter through your decisions. But look, if you're looking for a CPA firm that understands real estate and alternative investments and strategies like this, we are accepting new clients. So if you are interested in having that conversation, visit www.therealestatecpa.com/podcast to request a free 30-minute discovery call. We'd love to learn more about your situation and discuss how we can help. And of course, if you are a CPA or EA, you're listening to this, we are in hiring season right now. We are looking for staff across the board from tax senior all the way up to senior tax manager. So go ahead and send us an email at onboarding@hallcpallc.com with your resume, your desired position, and why you want to work for a firm like ours. We look forward to hearing from you as well. But that's it for this week, and we'll catch you on next week's episode of the Tax Smart REI podcast. Oh yeah, one thing before we go. We did release Short-Term Rental Tax Secrets. If you've not already purchased it, it is a book, a comprehensive book on short-term rentals that hit Amazon bestseller. So if you've not already gotten it, I think it's a few bucks. You can get it on paperback or you can get it on Kindle. Just go to Amazon.com, search for Short-Term Rental Tax Secrets, and you can get it there. And now this time for real, that's it for this week. And we'll catch you next week on the next week's episode of the Tax Smart REI podcast. Thanks again for tuning in.